member of Joe Latte Toastmasters Club. I'm seated here today with two officers of my business to discuss some issues relating to evaluations, valuations of equities. The purpose of this role play is for me to exhibit the skills as a leader in building consensus on a topic or an issue amongst my team. I would at this point like to introduce two of my executives. I have Kojo on my side as the head of research, and I also have Francella to my right as the head of mutual funds business. We have two critical issues we need to resolve today, in fact by the end of the day. We have been looking at valuations of equities as investment analysts as it pertains to determining the price of stocks. We have two ratios we need to consider and agree as a team to continue using in valuing the equities. We have what we call the price earning ratios, and we also have what we call the price earnings to growth ratios. I will at this point like to start with Kojo to share some few thoughts on PE ratios or price earning ratios, and then I will continue with Francella on price earnings to growth ratios. Okay, let me start with you. Please share your thoughts in using PE ratios as it pertains to valuing equities.
Well, PE ratios has been a favorite of many analysts for a while. It's very common on the Ghana Stock Exchange to hear analysts talk about what the PE ratio of a company is, and sometimes we throw in the price to book of the company. The PE ratio is simply the price of a stock on the market divided by the earnings. It could be a past earnings, or it could be what we call a forward-looking earning. So that ratio gives you an idea of what the value of the company is. If you're going to buy something, you want to make sure that you understand what the value is, and you also want to know whether you are buying at the right price. So if it is low enough, it is favorable. If you deem it to be too high, then you want to maybe wait a little bit. Now,
please share your thoughts and looking at the alternative. PE, price per earnings to growth.
Thank you. So, in addition to what Kojo has said, PE gives us an indication of whether a price is trading fairly, we feel it is undervalued or it is overvalued. Now, to be sure, analysts have introduced what we call the PE to growth or PEG ratio, which goes a step further to look at the estimated earnings growth of the company. So in PE, we are just looking at the price and then the earnings per share, but we go a step further to look at forecasted growth of the company. Where do we expect the company's growth to be in the next few years? So that gives us a better indication or a clearer understanding of whether the company is truly undervalued or truly overvalued or fairly valued. Now, according to Peter Lynch, ideally, if your PE to growth ratio is less than 1, the stock is considered undervalued, which means when you buy it, there's potential upside that is, the price would increase for you to make some gains. Now, if your PE to growth is equal to 1, the stock is considered fairly valued. So the price on the market is considered the true value of the stock. Now, if your PE to growth is greater than 1, it is considered overvalued. That means the price you are seeing on the stock market is fairly higher than what the company is worth. And over time, it's expected that the market will make a correction and decrease the price. Yes. Now, I think I'll hand over to you.
Okay, all right. What I'm hearing from both you, Kojo, and Francella is that both ratios are essentials for us in determining the value of businesses. Okay. What we need to agree as a team that in going forward at our investment committee meetings, we need to know which of the ratios we'll be using, when, how, and for what. So from where you sit as head of research, between the PE ratios and the PE to growth ratios, when do you think we should use what and for what?
Well, in most cases, you find that you start with one, but going forward, because of the nature of the company, you may want to have, as it were, a second opinion by adding the other ratio. So I would say basically it is always good to use both ratios to have a good enough gauge of the value of the company. And also, like we said, the price to earnings to growth ratio is like a forward-looking ratio. It tells you how the stock is going to behave, let's say, in the next few years. Now, you want to know, especially if the stock has some growth in it or growth potential in it, you want to make sure that that is added in the valuation of the company. So you refer to the growth of the company to make sure that it gives you a better understanding of where the stock is going. And that adds to the value.
Okay. Could you use a descriptive word here that it's a forward-looking ratio? Francella, your thoughts on using projections when it comes to valuations? If you ask me what I see happening in there is some degree of subjectivity when it comes to the analyst determining the potential growth in the company. Comparing that to PE ratios that specifically use historical data that every analyst is privy to, what are your thoughts?
So what I'll say is, as we know, historic performance is not an indicator of future performance. At the same time, you as an analyst, you should be able to project what may happen to a stock for you to take advantage of now and benefit in the future. Now, in doing that, it's good to look at not just the company you are valuing, but other companies within the sector and the general economy and how that is going to affect the sector that the company is operating in. And that will guide your projected growth estimates that you are going to make. Now, you also look at the past growth of the company. Sometimes it will follow a certain pattern, and then you investigate why. If those events are likely to happen again, it guides your projections in terms of growth that you factor in there. So you don't, even though we are using a forward estimate in terms of the growth, we are being guided by what has happened to the company in the past, what has happened in the economy in the past, what has happened in the sector in the past, and future expectations. So it's a combination of both, because we are being guided by the past to make certain future decisions. So it's a combination, I would say a combination of both the past and your future projections.
Before our meeting today, the impression I had was that we're leaning more towards using PE ratios because it is out there for everyone to know the statistics we're using, more than the PE to growth ratios. But I'm gathering around this table right now, what I'm gathering around is that we are open to using both ratios. Is that the case?
That is very true. The advantage of the PE ratio is that it is readily available, it is open, and also it is very commonly used. So once you use it, you have a basis for comparison with a lot of other companies and a lot of what other analysts may be saying. If you go further to use the PEG ratio, then of course you are adding that element of growth to the company. And again, you are looking at particular sectors, let's say growth economy, sectors, companies that have a lot of growth potential that you want to find out. It may, the earnings may be nothing right now, but if you look at the growth, what the company is going to be in the next few years, then you would want to look at the price earnings growth ratio, and that will give you a better understanding of where the company is going.
Francella, where does this sit with you? That going forward we should be open to using both, or we should just stick to what is most popular?
I think I agree with Kojo, we should use both, because the PEG ratio goes a step further to confirm if what you are getting from the PEG ratio is truly what it is. Because you can have situations where the PE ratio is slightly lower, but then you have a PEG ratio which is higher, indicating a different pattern. So it's good to use both to get it further explains the PE ratio to give you a clearer understanding. Then you can throw in other ratios like mentioned, price to book, price to cash flow, depending on the sector, look at maybe a few other ratios, and then look at the industry as well to make your final decision. So definitely yes, we will use both. We will use the PE and then we confirm our finding with the PEG, and then put in other ratios to further confirm if truly the value we are seeing is true or it isn't, to guide our investment decision making.
Okay. What I have heard from both of you, Kojo and Francella, is that going forward, as analysts, it will be very important for us to consider both ratios in determining the true value of the equities we select, especially for our portfolio, and especially to inform the returns on portfolios for our clients. So thank you very much for your thoughts. I want to believe at this point that I didn't force the decision on any of you, but it was a decision among us all to decide that going forward, we will not just use the PE ratios in valuation, but we'll use a combination of PE ratios and then the PEG ratios in our valuation. Thank you for your time, and thank you for your addition to knowledge. Thank you.
Thank you
Thank
for
you
having
very
us.
much.
Thank you.